What's up, Graham? It's Guys here. So 2023 is probably going to be one of the most confusing years for investing. After all, stocks are the cheapest they've been in 2 years, but there's a chance they could drop even further. Real estate has only started to come back down, but the Federal Reserve is expected to raise rates even more. And Treasury bonds are beginning to look good, but there's a chance that you could miss out on even better opportunities if you're not paying close attention. That's why I thought it would be helpful to share exactly where I am planning to invest all of my money throughout 2023, where the next big opportunities could be, and what you could start doing today to put yourself in the best position possible to make money. Or I guess just not lose money, depending on which way you look at it. But first, the best thing that you could do right now that will have the biggest difference for the channel is to subscribe or hit the like button if you haven't done that already. Just one gentle annihilation of the subscribe button gets you 3 new videos every single week, and as a thank you for doing that, here's a picture of a chicken. Plus, if you actually do it, I'll stop asking. So thank you guys so much, and also a big thank you to Rocket Money for sponsoring this video, but more on that later. Alright, so what makes this year so much different from the last is that we're finally facing the repercussions of higher interest rates, skyrocketing inflation, and declining fundamentals to the point where investing is no longer easy. For example, consumers are only spending more money because they're eating away at their savings. Mass layoffs are only getting more common, with investors sitting on the sidelines, and the chances of a 2023 recession are getting greater by the day, with interest rates still increasing. So it's a lot like navigating a minefield of obstacles just to try to find the best way not to lose money. In addition to that, for a lot of newer investors, 2022 was probably the first year you've ever experienced a substantial loss after getting accustomed to random stocks going up 20 to 50% in a day because they had a good press release. So now that the markets are beginning to at least somewhat normalize, here's my own investing blueprint throughout the next year that I believe should hold up fairly well even if the overall market continues to decline. First, let's break down my current investment portfolio. Up until 3 years ago, I had almost all of my money tied up in several rental properties throughout Southern California. And when I say almost all of my money, I'm not exaggerating, it was pretty much everything. Throughout most of my 20s, I would pour almost every single penny I had into property renovations so that at the end of the year, I would be completely broke. Although I would quickly make it back and then just repeat the process over again. But as I began to realize, having all of my net worth tied up in 7 properties in one location is probably not the smartest of ideas if something were to happen. So in 2020, I began focusing my efforts back on index funds and the equities market just so I would have something different to fall back on. At the same time, I also made the choice to diversify into several alternative assets that I'd also be able to enjoy, like the Ford GT or Tesla Roadster, along with a small 3% allocation to Bitcoin and Ethereum. From that point on, though, more recently, I began buying treasuries and using money market accounts for anything that isn't immediately invested. And by doing that, my entire goal was to create a portfolio that could withstand any day-to-day market fluctuations without missing out on any potential growth. And as of today, it's broken down approximately as follows: 35% residential real estate, 35% equities and index funds, 22% treasuries and money market accounts, 4% alternative investments, 3% Bitcoin and Ethereum, and 1% in other. By structuring my portfolio this way, my thinking is that if one group or asset class takes a hit, the others should more than make up for it. And if the market continues moving higher, then the portfolio should go up right alongside with it. But now that we're approaching a new year, I have a slightly different investment strategy in mind, because the way I see it, we're probably going to see some really good investing opportunities throughout 2023, and it's important to understand precisely what to look out for so that way you don't miss out. To start, let's talk about the stock market. I think it's no surprise that since I started making YouTube videos back in late 2016, besides a small 6% drop in 2018, the market's been perpetually up. In fact, since then, besides this year, the worst year happened in 2020, where the market still increased more than 16%. However, it's important to realize that this is not a sign of a healthy market, and 20% returns every single year are just not sustainable. Like, just for some context, the market is currently down about 15% year to date, and if you look back even further, the last time that we saw a loss even close to this was all the way back in 2008, more than 14 years ago. So for a lot of people, this is completely uncharted territory, and it's a huge wake-up call that investing has risks and not something to be taken lightly. That's why I've always approached the stock market as an extremely long-term investment investing strategy with money I don't intend on using for the next 20 to 30 years. That way, all the day-to-day fluctuations make no difference whatsoever, and once you zoom out, you'll be able to see that it generally is very profitable to stay invested. For instance, one way to analyze potential returns is by looking at what's called the rolling 20-year period of the S&P 500, which basically takes a snapshot to determine how much money you would have made throughout every time frame. And surprisingly, throughout the last century, a 20-year hold has never once lost money. In reality, the worst 20-year annualized return occurred in 1948 at just under 4% a year, while the best year started in 2001 with more than 16% a year. Of course, the short term is an entirely different story. The first year, you have a 73% chance of being profitable, which increases to 80% in the second year, 90% in the fifth year, and 97% in the 10th year. This basically implies the longer you stay invested for, the higher the chances are you'll make money. That's why I've always invested with the mindset that whatever happens in between now and then doesn't really matter. So throughout 2023, I'll continue investing about 35% of my income throughout the S&P 500, total stock market, and international index funds, and then I'll do nothing until 2040. Yes, it's a very boring, slow, and stable approach, but it's one that I believe would be the best for a lot of investors who don't want to play the stock of the day. Although this is really only a small part of my investing plan, and the next options are where I believe the best opportunities could be. Although before we go into that, as we approach the end of the year, I usually use this as a time to track my investments, analyze my spending, and find ways to improve. Like, even though I try to be diligent throughout the year, it helps to have an efficient system that does a lot of the legwork for me. That is where a sponsor, Rocket Money, could help.